Can a bank survive if borrowers stop paying? This is the core conflict. Banks lend public money. When repayment fails, trust breaks. This is where non performing assets become critical. They are not just accounting entries, they signal deeper stress in the economy. A non performing asset is a loan where interest or principal remains overdue for more than 90 days. It shows that the borrower is unable or unwilling to repay. This affects bank profits, capital adequacy, and credit flow. High NPAs reduce lending capacity and slow economic growth. Classification of non performing assets is time based and risk based. A loan first turns into a substandard asset when it remains NPA for up to 12 months. Here, recovery is uncertain but still possible. If this stress continues beyond 12 months, it becomes a doubtful asset. At this stage, the chances of recovery sharply decline and asset value erodes. Finally, when the loan is identified as uncollectible, it becomes a loss asset. This means the bank has almost no hope of recovery and must recognize the loss. Provisioning norms act as the financial shock absorber. Banks are required to set aside a portion of their profits to cover potential losses from these bad loans. For standard assets, a small provision is made as a precaution. For substandard assets, higher provisioning is required, especially for unsecured portions. For doubtful assets, provisioning increases with time spent in that category, reflecting rising risk. In the case of loss assets, banks must provide 100% as the loss is certain. These norms are guided by the Reserve Bank of India to ensure transparency and discipline. They force banks to recognize stress early rather than hide it. This protects depositors and maintains financial stability. However, high non performing assets in India have revealed issues like poor credit appraisal, evergreening of loans, and governance failures. Reforms such as asset quality review and insolvency and bankruptcy code have improved recognition and recovery. NPAs are not just a banking issue, they reflect economic health. Proper classification ensures early warning. Adequate provisioning ensures resilience. Together, they safeguard the financial system.